Okay, class. Today we're going to be talking about national income accounts, GNP, and some more of the accounting side of economics. So first, national income accounts records the value of national income that results from production and expenditure. Producers earn income. The amount of expenditure by buyers equals the amount of income for sellers, which equals the value of production. National income is often defined to be income earned by a nation's factors of production. So we have gross national product. This is the value of all final goods and services produced by a nation's factors of production in a given time period. Another definition of this is the total value of all goods and services produced by a nation's citizens. So what are factors of production? We typically have land, labor, and capital. So factors that are used are workers, which is labor services, physical capital like buildings and equipment, and natural resources, which are typically called land. The value of final goods and services is counted as US GNP. So GNP is calculated by adding the value of expenditure on final goods and services produced, consumption, expenditure by domestic consumers, investment, expenditure by firms on buildings and equipment, government purchases, current account balance, which is exports minus imports, which is the net expenditure by foreigners on domestic goods. So here's how that looks graphically. GNP is one measure of national income, but a more precise measure of national income is GNP adjusted for depreciation, which is when physical capital results in loss of income to capital owners. In unilateral transfers to and from other countries can change national income. So payments of expatriates workers sent to their home countries, foreign aid, and pension payments sent to expat retirees. Another approximate measure is gross domestic product. Typically, GDP is defined as the final value of all goods and services that are produced within a country's borders in a given time period. So GDP equals GNP minus payments from foreign countries for factors of production and payments to foreign countries for factors of production. So GDP is pretty much GNP if you take the foreign side out of GNP. So let's look at this in an open economy. We have this thing called national income identity for an open economy, which is Y, income, equals consumption, C, plus investment, I, plus government expenditures, G, plus exports minus imports, which equals C plus I plus G, and we can combine, or we can label the difference of exports and imports as CA, which stands for current account. So we have expenditure by domestic individuals and institutions, and we have the net expenditure by foreign individuals and institutions. So if we move things around, that's what we end up with. Production is greater than domestic expenditure, exports is greater than imports, current account is greater than zero, and trade balance is greater than zero. So when a country exports more than it imports, it earns more income from exports than it spends on imports. Net foreign wealth is increasing in that sense. So the opposite case, it's earning less income from exports than it spends on imports, and foreign wealth is decreasing. So here's national income accounts for a made-up country, agraria, in an open economy, and it is denoted by bushels of wheat. So let's look at saving within the current account. So we have national saving, which equals national income Y, that is not spent on consumption or government purchases. So we have S, national saving, equals national income minus consumption minus government purchases. Open economy can save by building up its capital stock or acquiring foreign wealth. So savings equals investment plus the current account. So private and government saving. Private saving is the part of disposable income, national income minus taxes that is saved rather than consumed. Government saving is net tax revenue, T, minus government purchases. So private and government add up to national. And here's what that looks like graphically. We have the current account and net international investment position. So you can see throughout time our foreign wealth has declined and our current account has also kind of declined. So we have balance of payments accounts. So this gets into the accounting side of things. We separate these into three broad accounts. Current accounts, which is imports and exports. Financial accounts, which is financial capital. And capital account, which is typically non-market, non-produced, intangible assets like debt forgiveness, copyrights, and trademarks. So here's an example. We purchase a fax machine from Olivetti. They deposit your check in a US bank. So we have minus $80 on the fax machine and plus $80 for that bank deposit. So here's another example. You buy lunch in France, pay by credit card. French restaurant receives payment from your credit card company. So the meal purchase is a US service import of negative 30. And we have a sale of credit card claim, which is $30, which is an asset sale. So we buy a share of BP, which is British Petroleum. They deposit the money in a US bank. And we have a stock purchase and a bank deposit, which is an asset purchase and an asset sale. So, for more examples, we have US banks forgive $50 million debt owed by the government of Argentina through a debt restructuring program. And we have debt forgiveness and then a reduction in the bank's claims. So how do these things balance? Due to double entry, the balance of accounts will balance by the following equation. Current account plus financial account plus the capital account must equal 0. That's by nature. So let's define these a little more finely. We have the current account, which is merchandise, services, and income receipts. Or we can call it net unilateral transfers. It also includes gifts. We have the capital account, which records special transfers of assets. This is a minor account for the US. Then we have the financial account, the difference between sales of domestic assets to foreigners and purchases of foreign assets by domestic citizens. So we have financial inflow, which is when foreigners loan to domestic citizens by buying domestic assets. Domestic assets sold to foreigners are a credit. And we have financial outflow, which is the opposite. So the financial account has three subcategories: official, reserves, all other assets, and statistical discrepancies. Statistical discrepancy is data coming from different sources with different coverage, accuracy, and timing. Official reserve assets are foreign assets held by central banks to cushion against financial instability. So these are things like government bonds, currency, bullion, or gold, accounts at the IMF. And then we have the negative value of the official reserve assets is called a fisherman settlement balance. It's the sum of the current account, capital account, and non-reserve portion of the financial account. And then we put in that statistical discrepancy factor. So here's what our balance of payments looked like in 2012 in billions of dollars. So, the US has the most negative net foreign wealth in the world. Therefore, it's the world's largest debtor nation. Our current account deficit was about 440 billion, so net foreign wealth continues to decrease. The value of foreign assets held by the US has grown since 1980, but liabilities, which is debt held by foreigners, has grown faster. Here you can see that.